Hi, getting near the end now. We're going to talk about hospitals. Again, some are run by the government, so government standards apply. Some are private, not for profits. Think of Christus Spawn, Santa Rosa, those kind of things. They're private and they're not for profit. There are some for profit hospitals, Humana and Health South and things like that. But a lot of them are not for profit, and they're either government sector or private sector, not for profits. What makes hospitals different and why we break them out from just, Red Cross or YMCA or the, American Cancer Society, why we break them out is they have a lot of third-party providers making the payment. So, right, think about it, you go to the hospital, who pays for it? Your insurance. And they have a lot of non-revenues because they're not for profit. And anybody can go. If I'm sick and I don't have insurance and I don't have income, I can go down to the hospital. Not all of them, not the for-profit ones, but I can go and get treated, and they have no expectation of payment. So there's some unique things going on at hospitals. So we'll take a few minutes to talk about hospitals. We're going to talk about the kind of reporting requirements, which is the same. There's just a couple of revenue recognition issues we'll want to talk about because of those third parties. And prepare the financial statements. So make sure you understand the distinction. So investor owned, Humana Inc. stock is sold on the NYSE. It's just a corporation. So that's investor owned. Private not-for-profit, St. Joseph, owned by the Archdiocese of Atlanta. So Santa Rosa hospitals in San Antonio. There's a lot of private not-for-profit hospitals, mostly church-owned. And of course government-owned, so all the university hospitals are kind of technically government-owned, but there's also like Bexar County has a county hospital, Houston has Ben Taub Hospital, so there's a lot of just flat-out, Brackenridge in Austin, just flat-out government-owned, not even affiliated with the university. So 3 ownership types. So what does that mean? Well, they're going to have different standard setters, right? So Humana as a corporation, it's just answers to FASB, specifically the standards that apply to any public company, right? So you don't use the not-for-profit standards for Humana, all right? St. Joseph's also follows FASB, but just the not-for-profit stuff that we've talked about already in chapter 10 and 11. And of course a government-owned hospital, like say Ben Taub Hospital in Houston, is going to follow GASB. All right. There is some additional some additional guidance provided by AICPA. So you might, if you were ever end up running a hospital, working at a hospital as the controller or something, great. You know that there's this AICPA guide out there. What are we talking about? We're not talking just about like a big hospital. It could be a medical group, a doctor's practice, one of those urgent care centers, nursing home, rehab center. So what we're talking about applies to all of these because all of these are getting paid by those third-party providers. Who's a third-party provider? The government with Medicare and Medicaid, insurance, Blue Cross, Blue Shield, United Healthcare, all of those kind of things. They're the ones who really pay the bills. All right, so any organizations like that. Why does it make a difference that there's these third parties? Well, typically these third parties will negotiate discounts for services. So if I walked in and said, "Hi, hospital, I need to have my appendix out," and they'll say, "Okay, that'll be $5,000. But Medicare, Blue Cross, big insurance organizations will go to the hospital and they'll negotiate. They say, "Look, we're going to reimburse you this much. We're going to send all our patients. You're going to be our in-house hospital, or in-network, they call it, in-network hospital, where all our patients are going to come to you. So we're going to reimburse you $4,000 per appendectomy, because that's what we think is a fair price. But we're going to send you like all of them. So there's that, right? So they negotiate prices downward, right? Because they have all that purchasing power. So what do we do with that? Well, we record them as contra revenue. So we'd put down there, let's see if they show us, just like this. All right. Contractual adjustments. Right here, contractual adjustment and patient accounts receivable. So we'd put down revenue, 5,000, appendectomy revenue, so we keep a separate category. Appendectomy revenue, 5,000, contractual adjustment, 1,000, patient accounts receivable, 1,000. And sometimes people aren't going to pay. They show up at the hospital, I have no insurance, I have no money, I'm indigent, but look, I just broke my arm, so I need some help. And the hospital will help them, and they just don't make a transaction for the revenue. Hospital financial statements are a balance sheet. They classify their balance sheet, current, long-term. Statement of operations, changes in net assets, or changes in equity if investor owns. So typically, a private not-for-profit is going to have change in assets, right, with their classifications. But if it's Humana and it's just a public company, it would just have retained earnings and stockholders' equity, common stock, right? So then you would have changes in owner's equity, and cash flows, and certainly notes to the financial statement. Private not-for-profits and government-related entities that are for healthcare have to include a performance indicator. People want to keep track of hospitals and see how they're using the money. Is it going for healthcare, things like that. So you do have these income measures that you include. When you prepare your financial statements for a hospital, remember how we're going to take those adjustments out. So when you see revenues, that the adjustments are already taken out, and if somebody got some free service, that's not included as revenue. Operating revenues do get classified, so if you look at their statement, you wouldn't just see revenues minus expenses, you'd probably see net patient service revenues, which is net of the contracts for lower care and lower price for care and the people who just didn't pay. So net patient service revenues, premium revenues. Sometimes we have agreements where we're going to provide services, so for a fixed fee. Other revenue, parking lot, gift shop, cafeteria, and gifts may be treated as operating or non-operating depending on the policy. FASB versus GASB. So you already know this. FASB for the not-for-profit. So let's say we're doing Santa Rosa Hospital. So it's a private not-for-profit. Assets minus liabilities equals net assets. We know that. And three kinds of net assets: unrestricted, temporarily restricted, and permanently restricted. No different from what we've learned before. And GASB, same as what we've learned before. Assets minus liabilities equals net position. But there's three kinds of net position: restricted, unrestricted, restricted, and net investment in capital assets. Two statements take the place of the statement of activities, right? So you've got a statement of operations and a statement of changes in net assets. So operations is for unrestricted items. Statement of changes is something not-for-profits have to show how the net assets changed. Financial position is like a balance sheet. Classified similar for not-for-profit, government, and commercial businesses, except for the equity section, right? Not-for-profit has net assets. Government has net position. Businesses like Humana have paid-in capital, retained earnings. Cash flows, again, businesses use the FASB. Not-for-profits use the FASB, so there's 3 sections. Government use the GASB, so there's the 4 sections. I'm sorry. Statement of cash flows. Use the 4 sections. All right. Thank you very much.